Welcome to Surgeon Syndicate. If you're paying attention, you know that you only make money when you work. It might be great money, but it's dependent on you. The information on this podcast will help you solve that. We interview experts and provide analysis into financial freedom through commercial real estate. Why? To help physicians like you thrive. Let's dive in.
Welcome to Surgeon Syndicate. This is your host, Dr. Michael McManus. On today's show, we're going to go into a little bit of our upcoming webinar series and what this is going to cover and a little outline of why we're doing it. And the whole point of this is we're kind of going back. I've been talking to more people now who are very early in their journey and just going to give you kind of an outline of the things that I wish I had known when I started and how those all fit together, and then kind of what each of the subjects for the webinar series is going to be. And what we're going to do is I'm going to do some podcasts kind of on the same topics. And for if anybody's going to participate in both, the podcasts ought to give you a nice introduction, and then the webinars are going to be very interactive. So it's going to give people a chance to ask questions, to participate in the whole thing, and hopefully with that, you can come out of it with a much deeper understanding than if you'd heard it for the first time. So before we dive in, I love the funny story. So I'm going to tell you a funny story. So, after we've talked about the pirate episodes and how everything I'm trying to do, well, it was this crazy move last summer, just getting ramped up again. And then I have this retinal detachment, driving through that one. Right as I'm getting over that, we have a death in the family and a funeral, and it wasn't unexpected, but it's still, there's a lot of emotion that goes on. And, it just takes a lot of energy. And right before that, I find this new deal that, could really be a great deal, but it's taken a lot of work to try and get it to the point where we can finish it off. So I'm trying to accomplish this at the same time of recovering from the eye surgery and having the other things going on. And right when I think I'm ready to launch back into getting a lot done, they're supposed to just be lasering a little tear in the other eye. And lo and behold, it's another retinal detachment. So I get that fixed a week ago. We already talked about that on a show. And it's like double agitating compared to the first one, because the first one, like, okay, I got to have this done. I'm recovering. And now we're going through it all again. And I've learned a lot of the frustration of patients. You always know they're frustrated when things don't go as planned, or, well, look, you have to have a second surgery. And being on the other side, I understand it even a bit more now. So in all of this, so the day after, my last follow-up on my eye, and that's all going great, I'm going back to see the orthodontist. And the whole plan was, since we moved, it's a new orthodontist. He wants to do things a little bit different. And they got a lot more creativity there in their world to do things different. And the plan was they were going to take all the braces off and put on some new ones and change things around. And so when they get in there, we take a bunch of x-rays and stuff yesterday and look at it again. And he says, you know what, I think we should just change the plan. And we're going to it's going to happen twice as fast, because when you're my age, your teeth don't move very well. He's like, I don't like the way they've been moving. So instead, we're going to take your braces off and we're going to push your teeth kind of back where they were and reopen up this gap where there was a baby tooth. And then we'll do a dental implant, and it'll cost a little bit more money. We'll have to send you to the oral surgeons to get the implant, or the endodontist, whoever does those. But we'll get through it and instead of a year and a half, in about 9 months. I'm like, oh, I like that idea. And so we're changing this plan. So this all sounds great. So they pull off all the braces. So now I'm braces free. It's great because I don't have these things digging into my lip anymore. But there were also these little screw anchors that were put in to pull my teeth on the bottom and close those gaps. So we're taking these out. This is a good thing, right? So they numb it up. And so I guess the mistake, I don't even know if it's a mistake. It was probably my fault because I was swallowing too much. But the local that was supposed to be just in my underneath my front lower lip runs back, numbs my whole tongue and my throat. And I don't know if it's just a sensation. This would be for anybody out there who's an anesthesiologist. So I feel like I can't swallow. So I feel like I'm choking on my own saliva. Um, it's a little bit disconcerting. So what happens in the end is they just kind of take me in the back room. So all these kids and other patients don't have to watch the dude with the half gray beard there looking like he's choking to death, and take me in the back. And I basically just sit there for an hour, leaning forward so it's not going down my throat, and with a suctioning everything out. And it wasn't that big of a deal actually. After the first like 15 minutes and everything's a little less concerning, I started going through my email. You got to get some work done. But but by the time I get home, I'm just exhausted. And I had work to do because we're trying to get this industrial deal under contract. And so I've like two of the best deals I've seen in the last 4 years, right at the same time come along. So I'm trying to get them both done. And this one, I've got this time blocked in the evening. I'm like, I'm going to get this done tonight. I get home and I'm just exhausted and I fall asleep. So instead I'm up at 5 a.m. and I'm doing it this morning. So um I don't know. I just the whole story of it, I look back and I'm like, oh my goodness, what is this just me, or is it just that life's going to give me challenges right now? But uh, you know, hopefully nobody else out there is going through these challenges. But if you are, my best wishes are with you, and I encourage you, keep grinding forward to get to where you want to go, because I still think it's worthwhile. And I'm excited that we have these deals going, and hopefully we'll get them to the finish line here soon. But so diving back into our webinar series and our podcast series, what we're kind of looking forward to is we're going to highlight how these are really designed um, for kind of our mid-career. I don't know, you could be anywhere in your career, but really we're looking at mid-career surgeons, and the idea that now you got some investable money, you're cruising along, and now you want to see your money working harder for you than it has been, get some tax advantages out of it. The last show we did, I kind of got out of order a little bit, but we just talked about why real estate syndications and kind of the difference between those and joint ventures and active and passive investing. If you're new to this space and really wondering about why is syndication, what it does for you, go back and listen to the last show. I think it was a pretty good episode and has some good baseline information. So where we'll go from that is really looking at, an overview and introduction to commercial real estate asset classes. Now, most people out there, when they talk about investing in real estate, the biggest thing that most people are doing is they go out and they buy some single family homes, or maybe some small multifamily that's a duplex, a triplex, and they're kind of running themselves, or maybe they have a property manager. When we start talking about commercial, we're talking about bigger stuff. And on this show, we're not going to spend a bunch of time on multifamily because there's a bunch of shows out there that do multifamily. And so the asset classes we're going to really dig into are industrial, retail, and office, and may talk a little bit too about land and land entitlement. So industrial, this is really warehouses, which can be logistics centers, but also maybe manufacturing, can support everything out there where we're building things, or it's part of shipping and distribution, um, or anything bigger that's storage. Also in industrial comes things called flex space. These are kind of like contractor garages and maybe smaller places where there's a little bit of office, but also a place to store stuff and maybe assemble some small stuff. So that all falls under industrial, and we'll do some. We've done some shows in the past. We'll do some more follow up on really what is industrial and what's investing industrial all about. Next is retail. So retail again is more stores where the general public comes in and shops. This can be shopping center, what used to be called strip malls. We like to call retail centers. Um, or standalone stores, or single tenant stores is what we typically call those. There's a lot of changing dynamics going on here. 10 years ago, everybody's talking about the death of retail due to online shopping. And what's actually happened now is retail vacancy rates are at an all-time low. So actually the retail out and about is thriving. And probably the biggest change we're seeing now in big retail centers is we're seeing this combined kind of a hybrid model where bigger retailers are combining their online shopping and their in-store experience. So where either people are shopping online and they'll have things online where not only can you order stuff, but they'll want to draw you into the store. And in the store, they'll have things that pique your interest, but maybe you're going to go home and look at it more in detail online, but they're working on making these two things work together. And then when we look at smaller neighborhood retail centers, it's stuff that you can't buy online, like your nail salons, your hairdressers, and things like that, or your Starbucks, your fast food and things like that. So office, we've talked a lot about office. Office is like the redheaded stepchild right now. And what happened during COVID is everybody started working from home. Office went through a big downside. What we've seen now is smaller suburban center office is actually killing it right now. And this is basically people who are working from home, but they don't want to work from home. They need office space because I'm one of those people. I'm renting a small office right now talking to you because I can't work from home. There's too many distractions. There's too much other stuff going on. I can come in here, man. I can dial in and go. So those spaces, especially where somebody can leave and they can walk and go have lunch, um, those places are full. They're thriving. And so when we look at other office places, downtown big class A office used to be the number one asset class. It was something that really was all owned by big private equity. Um, and now some of that is where the big struggles have been. But it may have hit bottom. You always hate to call a bottom, but it never got as bad as was predicted by some in the big cities. But because again, big private equity came in and bought up the struggling buildings at a discount, but it wasn't rock bottom, totally distressed discount because they believe that that money it's a good place to park money. These are people who aren't looking to get high returns. They're looking for some return and stable returns. And they believe buying these buildings that sometime in the next 5 to 10 years, they'll do great. And it's just a safe place to park money. So even downtown office hasn't seen the Armageddon that was predicted. Um, but some of the other bigger office buildings that are maybe suburban office parks, some of those are suffering, some of them aren't. And this is one of the places I think we're going to see some of the biggest opportunities. We're looking at some office opportunities right now that could be out of this world. And really, the play here is that we're buying an office that in the short term pays for itself, pays the bills, and on the long term, as a lot of these companies look about bringing everybody back to work, has a huge upside. So it's kind of buying at a rate you protect your downside with some huge upside. Really excited about office. Moving on. So why commercial real estate and why is it attractive to syndication investors? Um, so commercial real estate offers higher returns typically than residential properties. These properties are typically much larger, they generate more income, and they're less prone to fluctuations. And this is what I like about the non-multifamily space. A lot of the multifamily operators right now are looking at there's some great deals going on out in multifamily now, some distressed properties. But the discussion in the multifamily space is what's going on with rents. Rents shot up post-COVID. Now those rents have stabilized and some markets are coming down. But in the multifamily space, a long-term lease is 1 year. And so they are always concerned. They always have turnover every month. And when rental rates drop in the short term, they feel that. Now, the difference when you're looking at retail space and office space and industrial, typically a short term lease is 5 years. Now, some mom and pop stores, you might do like a 3 year lease, but typically you're looking at 5 to 10 year leases. So there aren't short term downturns. It's all about when you do the lease up that the lease makes money at the point that it's signed and it's set in such a way that it continues to make that money over the course of the lease. Now there's still some some risk there, some things that can happen. But the reality is you can lock up those returns for longer time periods and you don't see the same fluctuations. And so it's much more predictable. And that's what makes commercial better in my perspective. So as a passive investor in these bigger deals, you get a piece of large, stable assets with professional management, and you get much more predictable returns. And also, your tenants is when you get the deals that I love, you have Class A credit tenants. What that means is these are companies that are publicly traded companies, and they have their credit rating is part of what allowed them to raise debt. And when you put those tenants in your building, it raises the value of the building because the risk of them not paying their rent goes way down. So you have better tenants than just a residential renter. So what are some of the key factors in assessing these commercial properties? Big ones are market trends. You like to buy buildings in places that the market is growing. You don't like to see a decreasing population. That's bad across all asset classes. There are some people out there that are really looking for the more distressed properties that super understand the market and still know where to find them. But overall, you want to see good employment rates, you want to see rising population, and you want to see economic development. You want to be in a place where the world is moving to, not where the world's moving away from. Location is always critical, and real estate is hyper local. So even here in Salt Lake City, um, been looking a lot at office. So depending on the part of town of where you're renting or where you're buying office buildings, it matters a lot. And we're talking just, a few miles apart as to where the supply and demand sits in there. So it really takes having a deep understanding of where that market is. If it's industrial, depending on what type of industrial, how close is it to a highway, what type of access is it, what type of roads, if you're bringing bigger trucks in and out, all of these things make a difference. And so just a few blocks can make a difference. And so that really location becomes a big, big thing for all property types, but it changes for different asset class. Um, so syndication structures and how deals are made. So we talked about this a good bit in the last podcast, so we're just going to breeze over it here. But basically, you have two different roles: the general partner and the limited partner. Sometimes the general partner is called the syndicator or the sponsor. This is the person who finds the deal, finds the financing, manages the property, and either handles day-to-day operations or hires somebody who handles day-to-day operations, but they manage the project. The limited partners are the passive investors who provide capital to the deal. So they don't have any management responsibilities. They put their money in. If things go well, they receive their money back out. So as a limited partner, your biggest job is understanding the deal ahead of time. That's when you're doing the work, and you're doing the work on vetting the sponsor and vetting the deal. And once the money goes in, you sit back, and the downside, you don't have control. The upside is you don't have to do the work to get the returns. So how is capital raised? And then how are these returns distributed back out again? And so typically, the capital is raised either by the sponsor itself. The sponsor goes out and finds investors. And so that's kind of a direct capital raising model. Who do they raise it from? Depending on who they look to raise from, they may raise it from individual investors, which is more of most of our audience here, usually higher income individuals. If Depending on how the deal is promoted, may require accredited investors or not accredited, and that'll be part of that show when we dig into this in bigger detail. But some people raise institutional money. That could be from funds, from offices, from family offices, from insurance companies. So there's different places depending on the deal of where they raise that money. There are also people out there who are just capital raisers, and they typically have what's called a fund. And so where the capital raiser comes in is people developing projects, and often your sponsors are good at finding deals, they're good at financing deals, they're good at running the deals, and but they don't like going out and asking for money, or maybe they're not good at it. So what they do is they partner with a fund, and the fund manager is a person who is good at raising the money. So they're good at going out and talking to people about what they do with their money, trying to meet their investor goals, doing the investor relations, managing the investor distributions. So it's part of the bigger job that's required in a syndication. And they just focus on that one part, um, of bringing the money and managing the investors. So once the money's raised and the deal's going, how does the money go back out? So typically, the first step are called preferred returns. So when you look at a deal, you may hear it as the pref rate or the preferred return. That is typically something that's like 7 or 8% is where we're at on most of them right now. Sometimes it might be 5. If you're looking at a 5 preferred return, typically is a super safe, low risk deal, but doesn't have as big of an upside. Um, so the preferred return is the first money paid out. So the rent is collected, the mortgage is paid, the expenses are paid, and then there's some profit. And then that profit, the first place the profit goes is to the preferred return to the limited partners. And this goes out before the GPs get any payment to them as profit. Now, depending on how it's set up, the GP may have a management fee that's paid as an expense first, or they may not have a management fee and they don't get paid until after the LPs have their preferred return. So there's something to look at, and that's all about how we're balancing, um, having the same motivations between the GP and the LP. In some deals, if they say a 7% pref, the first year or so may not meet that 7%, but then there'll be payments that come later that bring it back up to that 7. So it may be like 4 in year one, and then 8 and 9 to get back to the 7 or something like that. But that's the money that's paid out first out of the profit. And then after that, there will be distributions that's typically called a waterfall or a split. And those are typically, I would say the most typical is a 70-30 split. And now when we're splitting up profits, 70% of the profits go to the limited partners and 30% to the general partners. Um, and if it's a really good deal, then there might be a hurdle. And that hurdle is, say, when the limited partners reach a 15% return on their money or a 20% return on their money, then the split shifts to like a 50-50, where now the general partners make even more money. But what they're saying is the limited partners have to make they get paid first up to that point. And then if the general partner does a really good job or they found a really good deal, is where then they make more money after the limited partner. So often these splits, if you see a split that goes, that after 15% or 20% goes to the GP, um, or after that initial split, that it gets better for the GP. Those are usually really good deals. And some people get upset. They're like, why does that go? Why don't I keep getting my 70%? And really it's saying that, once you've gotten to 20%, that's pretty good return. Um, and the sponsor now, they make their money, and they got to pay their bills too. So we'll dive into that one a little bit later on another show, but there's basically how capital's raised and then distributed. So the last part of syndication structure is risk mitigation. Now there's lots of different types of risk. GPs will use different strategies to mitigate risks. They include conservative underwriting. What that means is when you're doing the numbers on the deal, is you use a a worst case scenario. So you use like your highest possible expenses and your lowest possible revenues. And what that does is, if you make the deal work in a worst case scenario, and you're like, yes, it still works in that worst case scenario, that's the way you want to underwrite it. When people look at, oh, we're going to underwrite it to a best case scenario, it's really easy then for it to not work out well. So conservative underwriting is a risk mitigation. Um, contingency plans, which basically says what happens if we lose tenants, we have some sort of disaster like a fire, your tenants move out. A lot of these different things are then what are you going to do in that case? And then you have a plan for that. Um, how long are your leases and leveraging longer term leases? So um, if you're buying a property with long-term leases in place, that's lower risk and is typically called a stabilized property. And because it's stabilized, you typically will have lower returns because you have lower risk. Um, One of the models out there for doing a value add or getting better returns is you buy a property with shorter risks because you're going to buy, I mean, with shorter leases because you're going to buy it cheaper, and then you release it up. And these are people who are typically really good at leasing up and understanding those markets. So there's that risk of the lease up, but typically have better returns. So as a limited partner, you benefit from the strategy and understanding how to manage that risk and what's your kind of risk reward. And I think it's one of the bigger things to deal in is all the different ways that risk is managed. Um, One of the big things I've spent a lot of time this week talking with people about is really plan management risk. And what does that mean? And that's really like once the plan goes into effect, how many things can go wrong? And this is what I love about non-multifamily commercial properties is because once you close on a multifamily deal, that's really where the work begins, where all of the implementation. You got to lease the place up. You got to fix it up and get new tenants. You got to always be putting new tenants in. So there's a bunch of work involved, and that is management risk. Or on the other side, if we're doing an industrial building with a triple net lease, all the risk management is really on the front side. Because after you close on that and you close that lease, then pretty much all of the responsibility for the building goes to the tenant. And as long as you're checking in on your tenant and they're doing well in their business, they have all the risk that they have the risk of insurance rates going up, they have the risk of taxes changing. And pretty much as the owner now, there's minimal to no implementation risk because you've got a 10-year lease. You know exactly how much money you're bringing in and pretty close to exactly what your expenses are. So that's another type of risk. The other type of risk that we've been talking about is time risk. So in some deals, there's actually less risk to be in and out of the deal faster. That can increase taxes, but it decreases the amount of change that can happen in the world while you're doing this deal. Where a 10-year hold, there's a lot more things that can change in the world. So there's some time risk there. But if you're set up for a longer term, can ride things out, there you have in that longer term situation, you have more risk of things that can change. But if the deal is built to be in it for a long time, then you don't have to worry about getting in out of the deal. So that's the differences in time risk. So lots of different risk, and we'll dive into that in a later show. And what'll be really exciting is the webinar talking about that, where people can ask questions and kind of delve into all this different risk stuff. Maybe we should do a whole webinar on just evaluating risk. So, as a passive investor, then let's look at evaluating syndication opportunities. This is going to be one of the other show topics, webinar topics. So how do you evaluate a syndication sponsor? So a big one is experience. They have a proven track record that's key, and that they've navigated multiple deals through different cycles, um, and in similar situations. So this can be a tough one. It's kind of like a doctor leaving a residency. Like you got to get experience somewhere. And so the key here is the way that a sponsor should be doing this is when you're early on, and this is what I do, is you go out and you find people that you partner with. And there's some sort of arrangement in there that usually is the less experienced person. You're doing more of the grunt work. It's kind of like being a resident or a med student and then an intern and a junior resident. You're gaining all this experience of seeing everything happen while you're doing the grunt work that the more experienced person doesn't have to do. And they have the experience to see the bigger picture and make the decisions. So for a newer sponsor, they should have, even if they're the lead one, they should have partners with a bunch of experience. Or if you're looking at a partner that the lead partner has a bunch of experience, typically you'll see some less experienced partners who are kind of riding along and learning. But when you're looking at the deal as a passive investor, you want to make sure there's experience in the deal. I'll admit to you, one of the deals that I invested in about 3 years ago, one of the worst deals I'm in, they had a big capital call. They totally mismanaged the project. Before the capital call, they mismanaged the risk. They did a horrible job. And basically, it was a group that had a bunch of experience doing self-storage who moved into multifamily. And everybody in the GP, all of their experience was in self-storage, and they blew it doing multifamily. Um, and so in that case, if they were a self-storage people who said, I see some opportunity in multifamily, let's go do some multifamily deals, they should have had somebody on their team with more multifamily experience. And I learned that one the hard way. So that one sticks out in my mind now. The next would be transparency of the sponsor. Does the sponsor share detailed financials and regular updates? Lack of transparency is a red flag. Now, some sponsors try and be transparent, but they're just not really good at communication. Think about some of the people you know as doctors. They're good doctors. They're not hiding things from their patients. They're not just really good at communicating, but they're actually good doctors. Um, and those ones can be hard to sort out because you get a weird feeling from them. But this can be a tough one to really say, are they hiding something or are they just not good at communicating? Ideally, those people should have partners who are communicators. And that's where a lot of the time you'll see a sponsor partner with a fund manager, because those two can talk the same language at a high level. But then the fund manager goes out and communicates with the investors because they're good at that, and the sponsor's good at running the deal. But it should always be that when you have questions, you have access to get those questions answered, and it shouldn't be hard for you to get a hold of them. And this is one of those things that you can do as a test when you're evaluating a sponsor is maybe you make an extra phone call that's kind of a pain in the backside type of move. But what you're seeing is, are they there when you have a question? And it's not just they're available before they get their money, but they're available after you get their money. And this is where I like doing test deals where you go in with a sponsor for the first time at a lower amount, and and you see how they are. And so there's less risk based on the amount of money you're putting in. And then the track record, there's what we were talking about with the experience. How have their past deals gone? And I always love the question is, how have past deals gone wrong and how did they handle? Because I'll tell you, when deals go great, everybody's happy and nobody cares. Money's flowing in. It's when they don't go well, and how do they handle those? And can they fix a bad project? I had one of those, another multifamily deal that I invested in, when interest rates were low and when interest rates shot up, that they were going to end up in a bad spot. And the difference they did is they immediately communicated and said, hey, these interest rates have turned against us. This is a bad thing. We've got some shorter term debt in this deal. We're going to sell this thing and get out. And it was one that before interest rates went up should have done like a 20% annualized return. They worked hard to get it sold. It went under contract a couple times before somebody closed, but in the end, we got out, and I made about I think it was a 12% profit on the deal. So it was pretty decent. It was better than most of the time you do in the stock market. But they saw the trouble and they got out. And there's part of where you see, how do people handle it when the plan doesn't go as planned? Um, so key financial metrics, the biggest ones you're going to hear out there are typically in the multifamily space, pretty much all they talk about is IRR, or internal rate of return, and equity multiple, which is basically what's the when in the end the amount of money you get back compared to the amount of the investment. So the internal rate of return is your percentage return after all money comes back. So after the project is sold, how much did you make per year over that time frame? And the difference there between the other one is cash on cash is the actual annual return, or it might be your pref. And so the big difference there is you invest an amount of money and then you may get 8 to 10% back every year is kind of a common thing. But then after 3 to 5 years, let's say 5 years, the property is sold, but it's sold for twice as much as was paid for it. So during the 5 years, you're getting back your 8%, which is part of the ongoing operating profit. And then it's sold for more at the end. And in calculating the IRR, that um, that increase in the amount that it's sold for is calculated back over the years that it was owned, plus the money that was paid out as profit along the way. And that gives you your percentage over those years. The equity multiple looks at that, the total amount invested and the total amount returned at the end. So basically that's if you invested 100,000 and over the course of the deal, you got 200,000, that would be a 2.0x equity multiple. And that would be the same as whether it took a year to get that or took 5 years to get that. That equity multiple doesn't change. And the IRR is the one that looks at how long it took to get that return. And then real world examples, a good deal versus a risky deal, so that they share a brief comparison between a successful deal and one that had red flags. Looking at, are they overpromising returns? They have limited experience or market miscalculations. The good deal versus the risky deal can be one that is harder to understand the risk benefit. And what I mean by that is when you're early on, things may seem risky that aren't, or may seem not risky that are. And as an early investor is probably why it's better to be in deals that are simple and make sense and are more common. Um, we're looking at an office deal right now that to most people it looks super risky and they want nothing to do with it. But all of the people who are in the deal are very successful long-term active investors who love the heck out of this deal and the returns that are possible. And in their mind, all the big risks that scare all the smaller investors away, they feel are completely mitigated and the potential returns make it all worthwhile. So it's a lot of the time, evaluating risk, a lot of it comes down to experience, and that early on being in simpler deals that are easier to understand is a great pathway. And we'll get into that more on that show. So, some key takeaways and action steps before we finish up this episode. So really the biggest benefits of syndication are passive income for passive investors. Then they can get into bigger deals with margins of safety and increased margins of return that aren't available to retail investors if you're just doing your whole deal yourself. It also allows you to diversify among some different projects and asset classes that's hard to do buying your own doing your own deals. The biggest part for a passive investor is really evaluating the sponsor and the deal before investing, because once the deal starts, you're just kind of locked in. The benefit is that once the deal starts, you don't have to do any more work and you just collect your returns. So my call to action for you is explore some opportunities. If you would like to do more learning, listen to the rest of the podcast that we're going to cover, just kind of diving into deeper detail on each of these topics, and sign up for the webinars where you have a chance to ask more questions, go a little deeper. And then the other thing would be is call some different sponsors, syndicators, have some discussions. Every discussion you have, that 20 minutes you devote to that call, you're going to learn something. And if you don't know what questions to ask, just ask them that, what questions would you ask right now? It doesn't mean you have to invest with those people if you don't like them. And their job is there to educate you. And they should understand that if you're new, and even if you just say, listen, I'm talking to a bunch of different syndicators, learning before I invest, and they should be happy to still have that conversation with you. So thank you so much for joining us here on Surgeon Syndicate. And I hope this has been of value to you. And, just really, I still think real estate syndications are one of the best ways to improve the returns over what you can get in the stock market at lower risk and in the right asset classes to smooth out those returns so you can invest a place where you pretty much know what you're going to get for the next 5 to 10 years. And then when the stock market goes crazy and there's all this drama in the news, you know that your returns are stable while everybody else is freaking out. So join us again here on the next time on the Surgeon Syndicate. We've got some great interviews coming up. And for our solo episodes here, we're going to keep diving into each one of these topics in greater detail. So again, thank you for being here, and we'll see you next time on Surgeon Syndicate.
Do you care about paying too much in taxes? And would you like to save more of your hard-earned dollars? Here's what we found. We found that most financial professionals have a one-size-fits-all solution. So the question is, would it make it easier for you to have someone tailor your tax solutions to your individual needs so you can keep more of your money and do what you want with it? That is exactly what we do at 𝐥𝐸LStra.
As surgeons, we know the difference between routine surgery versus life-threatening interventions. And I want you to know that I've used 𝐲𝐶 and her team for my personal financial intervention, and I love the results. I would do you a disservice if I didn't recommend them to you.
We'd love to help you, so let's jump on a call and see how we can collaborate. Simply go to www.𝐥𝐸LStra.com/McManus and book your free call today.
This has been an episode of Surgeon Syndicate. If you got value from this episode, you know other surgeons are hungry to become job optional, and you can help them by sharing this content today. Schedule a call and we can make a plan. Looking forward to having you with me on the next episode.